All right, everybody. Stocks by the numbers. Welcome back. Wanted to do a quick, broad overview look at Papa John's International Incorporated, ticker symbol PZZA, listed here on the NASDAQ. Now, compared to other companies that we have here, pizza franchises here domestically in the States, like Little Caesars, Domino's, do better ingredients and better pizza yield a better stock? So let's get into it. So Papa John's, as we see, for the most part over the years, was on the up and up throughout the decades. And you can see we kind of topped out, looks like the tail end of 2021. We've been trending downward ever since. So the stock right now is trading at $50.40. It was up about a third of a point today, 0.6%. We come down here, we can see a market cap 1.64 billion. Company's paying out a dividend, currently yielding about 3 2/3%. PE trading a touch below 24. Nice beta as well, about 0.5. Again, the beta is the overall volatility of a stock in relation to the overall volatility of the market, meaning that this stock is about half as volatile as the market. If we look at the EPS side, we can see that, in my opinion, seems like they turned some of the margins and some of the profitability metrics completely around. And as we see, we go from misses of about 6% up to nice beats here of about 20%, we'll say 15 to 25% here over the last 3 quarters. 3 beats in a row, beating on EPS, 3 of the last 4 quarters. You can see next quarter, EPS, though, continuing to slowly drip down and trend downward. But, of course, even if estimates do slightly drop, then as long as the company kind of consistently beats them, then technically it's a good sign, right? So if we look over here, we can see that we were trending upward with revenue getting to almost that $600 million mark in Q4, which seems to be their biggest quarter, kind of towards the end of the year. It's colder out, right? It's kind of like the holiday season. People have family over, so we're ordering up some pizzas. Fantastic. Q1, though, and Q2, we can see revenue kind of reversed, and we drop back down to the low 500 million mark. And Q2 last year, the company brought in 514.5 million in revenue. Net income almost 18 million. Now we fast forward here to this last quarter that was reported, Q2 of this year. You can see revenue down to sub 508 million. Net income about 12 million in change. Net margin 2.4%. So what it seems like is that, again, I don't want to necessarily be too pessimistic with the whole situation, but we may have potentially topped out at about this mid to high 500 million mark, and now we have sales slipping. And they even addressed that domestically here in US and North America, really as a whole, they are starting to see some slight slippage in orders, whether it's delivery or carryout. And of course, the rise in ingredient costs to the pizza locations obviously hasn't been working out well for them as well. And you can see the net margin percentage was a little healthier, obviously, several years ago. And now you can see that it's holding like 2-3%. So not the most profitable company, but the one thing I will say about Papa John's is that if you look at the dividend history just over the last couple of years, they maintained their dividend throughout 2020 when we had the lockdowns, and they actually healthily increased the dividend over the last couple of years. So that, in my opinion, right now seems to be the absolute biggest green flag for Papa John's Pizza. However, of course, again, the recent drop in revenue, definitely a bad sign in my opinion. And you can look here throughout the years. Back in 2019, total revenue came in 1.6 billion. We're up to 1.8. And then we get above 2 billion in 2021. And you can see the net margin percentage approaching 6%, right? 2022, revenue up slightly to 2.1 billion. Net margin took a big hit from 5.8 down to 3.2. However, still profitable. And now moving into 2023, 2.14 billion. Net margin climbed up a little bit to 3.8%. So it seems like we're kind of stepping upward, but also at the same time, the jumps that we saw from 19 to 20 to 21, we were looking at like 10-12% revenue growth year over year. Now, just over the last couple of years, we went from 207 to 21 to 214. So technically, the revenue is increasing year over year, but not at the same percentage rate that it was before these lockdowns. Which, of course, leads me to believe that more people are opting for different options, right? Whether it's Little Caesars, whether it's Domino's, or just going to the local pizzeria, grabbing a pie, getting a pie delivered. Because I remember the one thing I noticed as well after 2020 passed, when you would put in an order now on Papa John's or through Domino's, we know they have those extra charges at the end. And they entice you, they bring you in because they try to offer a deal, right? Oh, you can get a pizza for like $5, $6 or whatever. And, you're sitting there saying, wow, that's great. I guess I'll do that tonight. And then once you actually just put in the order, even if you get one or two things, it essentially adds, 50 to 100% more to your cost. And then, of course, you have to tip if you are inclined to. But you understand my point. That's also why I feel like a lot of people moved away from things like Grubhub and DoorDash, right? Because people were saying they're overpaying for their food to begin with, and then there's all these extra charges also, and then you're also saying that you don't tip the driver as the company. I have to tip the driver. So, it seemed like so much extra expense. That's why, in my opinion, I feel like people are opting for just better options, whether it's from Domino's or if they're just ordering a pizza from, the local establishment. But the recent earnings have been underwhelming. And I know they're trying to paint the picture because they're keeping the profitability up. And as I always said, it's basically putting lipstick on a pig for the short term. And they want to try to entice investors, entice traders, and make it seem like it's not as bad as it is when EPS is coming in line or better than expected, but revenue seems to be falling off and consistently missing. We come back here to May 23. You can see we missed by about 7 million, 1.3%. Then we missed again by about 3.2% or 17 million. Then we missed again by about 7.5 million, 1.4%. Excuse me. We missed again by about 7 million, 1.2%. We missed again by 30.5 million, 5.6%. We missed again by about 12.25 million, 2.33%. And, that is why, in my opinion, this is trending downward, okay? Because what you're showing me is technically is that, in theory, demand is slowing and business is slowing because you've been consistently missing more times than not on revenue estimates. Now, granted, certain things like the gross margin percentage is technically up slightly, this last quarter than the quarter before, but in the long-term scheme of things, it looks like they ran into a roadblock. And I know there was this new CEO coming in, and they mentioned something that caught my eye, because usually when it comes to these food franchises, something like a customer loyalty rewards program usually becomes very popular, and you start to see that kind of resurgence of that money flow come into the business. Even something like McDonald's, right? They said, oh, just download the app, and then, randomly, like once a week or once every couple of weeks, they'll say that you can get an order of fries or something for free if you show up and you have the app, right? So there's like these little rewards programs taking place, and it was mentioned in an article, and we'll check that out. So something like that could potentially turn this situation around, but in the numbers, in my opinion, it actually doesn't look too steady. And again, right now, market cap 1.6 billion. And for 23, the company brought in 2.14 billion, net income 82 million. But if we really break down a lot of these fundamentals, it kind of looks worse than they're painting it to be, right? So first of all, look at the dividend history, right? This is beautiful. 90 cents per share, 1.4% dividend yield throughout 19, held it throughout 20, increased it, coming out of lockdowns into 21 up to 115, increased it to 154, increased it to 176. Now listen, that will absolutely entice investors, especially for the longer term. You're telling me basically from 2020 to 2023, just over those 4 years, the dividends went from 90 a share to almost 180 a share. So you basically doubled your payout to your shareholders just over the last 3 to 4 years, which is absolutely phenomenal. The problem is, though, is that if we look year over year, the free cash flow is actually slowly dipping down. And if revenue consistently comes in below expectations, then it's only a matter of time before profitability begins to start taking a hit because there's less gross revenue to go off of. And that's going to probably translate, in my opinion, to either a dividend halt or a dividend cut. So here going, they might maintain it, not to predict too much, but they might maintain it throughout 24. And then if business doesn't pick up in 25, you might see a cut back down to like 170 or 150, in my opinion, right? So that is possible. The debt technically climbed over the last couple of years. It doesn't seem too crazy, though. As you see here for 23, it's below $1 billion. And if we look quarterly, we can see this time last year it was $1 billion, and it's slowly been trying to come down. 965, 963, 960. So technically, the debt is heading in the right direction. Free cash flow here a touch below 14 million. This time last year, 36.6 million. Cash on hand was about 44 million. Now it's 24 million. And this is what I mean when we look at these companies who are struggling to maintain and beat expectations on the revenue side. Because if you're not bringing in enough overall money as expected, you're still going to have to pay the piper down the road and pay for your goods. You're going to have to pay for your operating expenses, right? Your payroll. All of these expenses are still going to be there. So if you overextend yourself too much with the dividend, but now the cash stagnates and doesn't start rolling in consistently as it was a couple of years back, now you're going to find yourself between a rock and a hard place. Because you're probably either A, going to have to, do another offering to raise some cash, or B, you're going to have to cut your payout to shareholders so that you can keep the balance sheet looking more healthy on the business side, right? So that's why, in my opinion, I do think it might actually get worse before it gets better, but they do speak about the customer loyalty program, so that could potentially we could see a little bump up in revenue, but liabilities in both the short and long term being outweighed. And you can see here on the short-term side, we're talking, maybe like 30% it's outweighed liabilities to assets. On the longer-term side, I mean, you're talking about 50% it's outweighed liabilities more than assets. And if we come over here, we actually have negative equity. And if we go back to the tail end of 22, you can see the equity was negative 269.5 million. Now we're at about negative 450 million. And we've been holding that level, even though technically we're up a little bit from where we were here starting out in Q1 of 23. We're technically up, like 5%. But now, again, we're negative 4, almost 500 million when we were negative 200 million and change. So technically, on paper, in the numbers, in my opinion, the stock looks terrible. But it doesn't necessarily mean that the stock is not going to move, right? We saw something similar to this with McDonald's, right? The stock is several $100s a share. And if we actually look at the fundamentals, the book value, I think, was only like $5 or $6 a share or something like that. So depending on how you look at it, you could make the argument where it's going to keep growing or it's going to sell off bigly. The difference between those two franchises is, as we looked at the last several quarters, McDonald's has been more consistently, more times than not, coming in above analyst expectations, right? So the stock continues to maintain its value or even grow. They're able to consistently keep that dividend going, increase it over time. It's more of a steady situation. Papa John's has kind of run into a roadblock here over the last couple of years. And you can see the book value at this time was minus 8.25. Now we're sitting at negative $14 a share. So that's why, even if we look at quote-unquote fair value, it's actually much lower than where we're kind of valuing the company right now, in my opinion. So if you start off here, minus 450 million, we'll call it, then you have debt of 960 million, right? So you have to add that up. You're at what? Like negative 1.4 billion. If we look at the money they actually brought in, 2 billion, 80 million, so that's 2.2. So that's positive 800 million. And the market cap right now is 1.6 billion. So technically, you could make the argument that we're trading 2 times quote unquote fair value. But also at the same time, we're sitting here with negative equity that seemed to be widening over the last couple of years, and now we're sitting here with a negative book value that is almost doubled down in the wrong direction. And also, even though debt technically has gone from $1 billion plus to sub 1 billion, it doesn't seem to be moving at the same rate at which we're losing asset value, but still maintaining liability negatives. So, in my opinion, this is not one that I would own, but that's just me. And I know some people may be looking for a food stock, that pays you a dividend, one of these franchises and whatnot. But in my opinion, I think you might be able to find a better opportunity. And the PE we can see was up to almost 45. Now it's down to half that. It's at sub 24. We've been just trending downward and downward. And again, you could make the argument that we may even be trading at an overextended value here with the 24 PE. We're trading 0.78 times sales, which is about half of where we were. Price to cash flow sitting at 11.6 times cash flow. That's less than half where we were. Enterprise value right now, again, what another company would be willing to pay this company to buy them out, currently sitting at 2.59 billion, which is about $1 billion above the current market value. And in my opinion, I have to say I do not agree with that valuation. The return percentages kind of heading downward. The gross margin percentage dropped about 1 percentage point here from last quarter to the previous quarter. However, if you go back this time last year, gross margin percentage 16.57%. Now it's 16.92%. So this is what I mean. When these companies do these restructuring situations, it may be because they see a slowing down of business, or potentially just, like the ebb and flow of the popularity of their product or their service, right? So some things like the gross margin percentage or beating on the EPS side, right? Those are painted as big positives to try to keep the stock up. When in reality, the actual business has been slowing. The amount of business the company actually did over the last couple of quarters, you could make the argument that it has plateaued and they've missed revenue estimates, 4 or 5 times over the last 5-6 quarters. Right? So we're in a downtrend. We have bearish momentum in my eyes with Papa John's. If a trend line or a tech pattern indicates we can go a little bit higher, that's obviously on the other side of the coin. But if we're talking as a business in the numbers, in my opinion, I personally don't like this one. And the operating margin, about 6.75%. It was slightly higher this quarter last year. And something like the EBITDA going from 9.8% to 10.2%. See what I mean? They're keeping the EPS now on the up and up while the revenue is trending downward. Net margin percentage was up to about 4.5%. Even recently there, what was that, Q4, I'm assuming. And then we dipped down to sub 3% and now sub 2.5%. That's the lowest net margin percentage it's been going back about the last 7 quarters. Inventory turnover kind of maintaining. Asset turnover, well, again, asset turnover, the amount of revenue the company is able to generate off of said assets on its balance sheet. The revenue is kind of maintaining that $500 million mark quarter over quarter, but we saw the assets trickling downward, leading to a wider loss of negative equity. Right? So seeing something like the asset turnover increase, I don't know if I would really count that as a green flag. Debt to assets, obviously, debt is kind of staying still. Assets are dripping down. So now we see debt to assets ratio go from 0.85 to 1.15. Long-term debt to total assets, 0.82. Now we're up to 1.1, right? So those ratios technically heading in the wrong direction. And while it may look very nice that the dividend is steadily increasing, I don't know, in my opinion, if it's really the right move for this company. And again, just over the last couple of years, you can see we went from 22 to 35 to 42 up to 46 cents a share now, being paid out monthly. And if we look at the EPS side, it looks like a beautiful story. We've beaten expectations 6 out of the last 7 quarters, rocking and rolling. On the annual side, same thing, actually struggling more going into lockdowns. And then coming out of 2020, we haven't missed an annual expectation yet. And it looks like they're supposedly forecasting continued profit growth here throughout 24, 5, and 6. However, they recently, I read the article, the analyst, I believe, trimmed the EPS outlook. So, and if you look on the revenue side, this is what I'm talking about, right? Q4 of 22 was the last time they beat revenue estimates. They have now missed revenue expectations 6 quarters in a row. There's only one company we know that can consistently miss earnings and go higher, and that company is Tesla, of course. And this is not Tesla, this is Papa John's. So the stock is trending downward. And now you can see, look at Q3 now, estimates of $497.85 million. We are now officially below that $500 million mark, looking to slowly get back above it for the remainder of 24 and going into 25. But this technically is a bad sign. And also, with revenue trending downward now to the low 500 million range, if estimates come in sub 500 million, and they happen to miss that estimate, I think the stock is going to get absolutely decimated. It should anyway, in theory, in my opinion. If we switch over annually, though, we can see on the longer term time frame, the company has actually been coming in above expectations more times than not, beating annual revenue expectations 5 of the last 7 years. Slight miss in 23 and even in 2018. So when they do miss for the year, it's not too wild. But again, with consistent misses now for the first half of 24, we may now be in danger to have back-to-back years of missing annual expectations, and then you may start to see funds sell off some of their positions in Papa John's, and you also may have, obviously, further analysts come out and downgrade the stock, put sell ratings, lower their price targets. So it might get ugly before it gets better, if you will. And if we look at the chart here, first of all, from these highs, right, this is why I like trend lines, going from these highs of November 5th, 21, I have this top trend line connecting to that next top, looks like the end of December right there, 21, cutting across there, right? So if we break out and really start to climb and beat estimates and get some good upgrades, we can potentially retrace to this trend line up here of 100 plus. However, again, we've been trending downwards since the end of 21. So this company would really have to make some announcements and really show the proof in the pudding that they're turning this around for them to break not only above this resistance level, but of course to rally all the way up to this top one. Also, if we zoom in a little further, you can see this other top that came out here, January 7, 2022. That's also cutting down from the top of this candle here, November 4th, 21, and that's going to that top there, and you can see it basically kind of meets up with that next top. It cuts through there right to the top of the body of those candles, and even though technically we have breaks above and below, look at the tightness dancing around this trend line. And now that cuts across, and we can see that we're potentially approaching that over the next month or two going into next quarter's earnings. So in my opinion, we can stay in this uptrend that we've been in since the end of July, and we can trend all the way up to about 58 and change. However, again, as I said, with this lower estimate now on the revenue side expected to come in, if they miss this number, the rejection is going to be massive in my eyes. And this blue line is also pretty important here. If we back this up, nope, gotta go further. If we back this up, okay, and again, this is why I love trend lines, right? So all I did was I went from the bottom here, looks like November 17, 2008, coming to the big dip it had in middle of March 2020, and I just drew that out and extended that line outward, right? And if we zoom in now, you can see, look, the stock after these earnings right here, again, big miss, over 5.5% on the revenue side. Stock chunks down. Look, tries to hold and retest that, 16-year support level. Breaks below it hard. Tries to get back above it. rejects, stays flat, tries to get back, rejects, drops down even further, and then begins to slowly bounce, tries to get back. We had earnings come out. Technically, they missed, but we're trending upward. And you can see, look, as it rose up, it tried to get back, technically rejected a little and paused, and then had a pop up, and then comes down. Look at these candles right there to test that long-term support level, and then rejected, and now kind of sitting basically flat for the most part today. But technically, we're still in this uptrend, right? And depending on how you want to look at it, we either kind of have an upward channel or we have kind of an upward trumpet. So the first thing you want to see, in my opinion, is the stock get back above the 16-year support trend line, now sitting at about 51.40, so about $1 move from here. And then you want to, the next fib level, this is a 5-year chart? That's a 1-year chart, my apologies. 1-year chart, this fib level 51.97. So you want to see technically a close above this 16-year support level, and then you don't want to see a rejection off this fib, and you want to keep going up to 54 and change, as you see, 54.70 potentially over the next week or so. But then if we come down, hopefully it doesn't reject here and it has a nice bounce and it can continue upward for you guys. And like I said, it looks like, mid to high 58s, maybe even 59 can be hit. But this right here, this blue line cutting across, is your 16-year support trend line. And that, in my opinion, is your most important level to watch. Because if they do miss those estimates, or they do reissue lower guidance, or they do forecast that it's going to be a more rough, tail end of the year than previously expected, any negatives like that, in my opinion, may seriously crater this stock down. And if we go down now to the other all-time support trend line, you're looking at about $25. So this stock may potentially be due for a 50% sell-off. And remember, the company's holding negative total equity right now and has a book value of negative $14 and change a share. So if Wall Street wants to take it from 50 to 25, with all due respect, you really don't have shit to say. You don't have a leg to stand on. Right? Company's consistently missing earnings, basically, for the last 2 years on the revenue side. Negative equity. You still have a bunch of debt. Your cash flow dropped down. Your revenue is potentially deteriorating. You're losing market share, right? So to bring this on a big break down to this trend line, 25, 26, believe it or not, isn't too crazy. And just to draw that out for you, I went from the initial bottom of the week of, it's weekly, the week of June 7th, 1993, to that other bottom in mid-November of 2008. And you can see I stopped right there and then extended the line out. And this is why I like trend lines. And also, look at this, right? We were at these highs throughout 21, early 22. Then we had a big drop all the way into May. And then we had a nice little healthy kind of 50% retracement bounce. And then we rejected and dropped even lower. And again, I love trend lines because if you go from the bottom of that trend line, May 20th, 2022, to the bottom there, October 7, 2022, right? I just extended that out, connected those two, and just extended it out to where the stock is. And look, if we zoom in, look at that. Stock came right down at the bottom of the bottom to that downward channel bottom support trend line, right? Came right down to it and has since bounced and is now in an upward channel. So that's why I like trend lines. But again, everyone's different. There's a million technical indicators to look at. So if someone says, oh, I like looking at VWAPs instead of that, it's like, yeah, okay, fine, whatever. Whatever works. Whatever you have success with. But right now, technically trending upward again. Got to watch that support trend line. Got to watch these fib levels. But you might continue to see kind of this up and up stepward pattern. And then if they happen to disappoint again, you may see a big rejection, retest that support trend line, and then potentially break down below it. But in the numbers, it's really not that exciting. And even in the chart, again, technically missing more times than not. And we're trending downward now for, 3 years, 4 years straight. So it's getting rough right now. But let's look at some articles here. So yeah, we got the new CEO. 3 stocks that may fall off a cliff. They're talking about RSI, Papa John's. Named this guy Chief Digital and Tech Officer. RSI, it was over 70. That's why they mentioned it. Okay. Papa John's files 8K. Compensation filing. Let's see, right? We shouldn't see any increases. Announced the promotion of this guy to CFO and Executive Vice President of the International segment. We'll assume additional responsibilities outside of US and Canada. I don't know. If he's worth promoting, I would probably, believe it or not, put him in charge of the domestic North American business and marketing, in my opinion. That's where the stagnation has been. But that's just me. In connection with his promotion, has approved an increase in his compensation, wrong word, which includes an increased annual base salary of $675,000, the same annual cash incentive target opportunity of 75% of base salary, and an increased annual long-term incentive opportunity with a value of $1.5 million, all of which will be prorated for 24 based upon his time in service. Well, it seems like a lot of increases and incentives for a board member that is kind of part of a struggling business. And I'll tell you right now, in my opinion, it's different because looking from the outside in, as a regular, average person, you would potentially have more ethics, a little bit more integrity than some of these board members, right? And you may even turn around and say, listen, whether I can get, $675,000 more or not, the company's struggling, get me in there, let me turn it around for you, and I'm gonna show you that I'm worth my weight in gold, right? But we know that that's not really how business is done a lot of the times on the public scale. But I mean, technically, I wouldn't agree with this, but at the end of the day, it's really not that much money also. But I don't know, things like that just rub me the wrong way, If the stock was consolidating for a few years, but the business was maintaining and you're, opening a few locations and 2025 is going to be like a good rebound year, right? If I was hearing things like that, then I'd be like, all right, give them a raise and then we're going to drop down and then we're going to start rallying back up and everything's going to be great. So, I don't know. That's just me, though. Papa John's extends PepsiCo beverage partnership with 10-year contract renewal. Papa John's said Tuesday it has renewed a 10-year contract with PepsiCo as its exclusive beverage supplier for North American restaurants. The deal will allow Papa John's to continue offering PepsiCo's beverage lineup, including Pepsi, Mountain Dew, and Starry, at its restaurants, the company said. In my opinion, that's a damn shame, because I feel that Coca-Cola has a much, much better umbrella of beverages. But we know that everyone can't get Coca-Cola. And we know that Coca-Cola's main flagship franchise is, of course, McDonald's. But, 10 years now, locking them up for the next 10 years. I don't know. In my opinion, I would have maybe shopped around. But again, that's just me. Renews, when it comes to the overall business of Papa John's, I'm sure, we're not going to turn around and say, oh, it's because you serve Pepsi instead of Coke. You know what I'm saying? So, really not a big deal. But however, 10 years is a long time. But I guess if no one's complained about the beverages over the last couple of decades, you're not going to fix it if it ain't broke, right? So, should you retain Papa John's? Papa John's price target maintained with 51 a share by Wedbush. This guy's smoking something good. Also not really that impressive, right? That's where the stock is right now. This was a month ago. Okay. Papa John's director acquires some shares for 100 grand. Interesting that we're randomly in an upward channel, kind of for no reason, in my opinion. And, you know, this guy steps in, buys 35,000 shares here at 44.5, and he's already up 10%. Papa John's maintain at hold at Deutsche Bank. And again, I guess it's worth holding in the moment because of how much they increased their dividend to shareholders, right? So this is why, again, you know, these analysts aren't going to be as aggressive as I may be. And they're not, you know, they're not going to come out and say, oh, you know, it's a strong sell, it's going to 25. I mean, technically, in my eyes, that's where the stock should go. But again, these people aren't trying to be too pessimistic with the whole situation. But maintain hold at Deutsche Bank. Price target cut to 45 from 58. That's a big drop. Papa John's maintain outperform BMO. Price target cut to 65 from 75. That's still very high. Papa John's maintained neutral at UBS. Price target cut from 58 to 47. So a lot of these cuts, as you see, like 20% and change, these price targets got slashed. And again, as much as the margins might be maintaining, as much as, ooh, we're beating on the EPS more times than not, these analysts are seeing technically the stagnating and the shrinking business and the revenue side of the actual company. And that's why, just like something like a GameStop, you can lay off workers, shut down a couple of crappy locations because your business isn't as hot as it used to be, and you can try to pump up and gloss over the revenue side with better profit margins and a higher EPS. But at the end of the day, your business, went from 1.6 billion to 1.2 sub-billion. Now you're down at like 600 million. Your revenue fell off a cliff. And that's why, even if they maintain this dividend and consistently beat on the EPS side, if we turn around another 4 quarters from now and they miss revenue 4 quarters in a row, then in my opinion, the stock is going to trend downward. You're going to see sub 30 in my eyes, and it would be justified. Let's switch over to stock charts real quick. I'll let you go. I try to do these quick, but they always end up being, 20, 30-minute videos. But RSI was running up to 70. I guess that's when the article came out. Then we immediately had a rejection and a sell-off there, and the stock pulled back again to about 50 and change. RSI right now 58.5 on the daily. But again, we've had times where the stock, as you see, look at that perfect timing too, right? This was when it broke that long-term support trend line level. Let me bring you in. Right? We're coming back here. May 24. We chunked down on these earnings and we started to approach that 16-year support trend line. Middle of May. Middle of May. Look at that. The RSI, when it chunked down, the RSI was already well below 30, but the short sellers kept beating it up and investors kept jumping ship. And the RSI dropped all the way, what is this? 11? 12 and change RSI, right? And that's another reason why I like to say, in my opinion, you have to pay attention to the fundamentals, because the fundamentals play a much, much bigger role in the movement of a stock than people think. People think it's all about charting. Let me just find, a descending wedge or a head and shoulders pattern and, oh, it's guaranteed. Number one, we know nothing is guaranteed. Number two, even trading off something like an RSI, imagine when it gapped down, if you jumped in and you said, oh, no, that's an overreaction. The RSI is 22. It's going to bounce. Stock continued to trend downward for 2 straight months. RSI dropped down to 11, 12, right? So that's what I mean. That's why you can't just say, oh, it's overbought, I'm betting against it. It's oversold, I'm buying it. You have to look at a bunch of different metrics. But again, we are trending upward since kind of the tail end of July for reasons unbeknownst to me. But we're bouncing off of this mid-Bollinger Band, so we can potentially drop back down to the low 49s here and then have another bounce. That should bring the RSI to sub 50, and then we may bounce and kind of continue upward in this channel. But the MACD looked like it was trying to cross to the downside, flattened out, and then we had the healthy bounce off the mid-Bollinger Band. So they might keep it on the up and up in this channel over the next 5-6 weeks. Going into next earnings, and then we'll take it from there. Let's switch over on the weekly side. We can see longer time frame as well. Look at that. May, June, July, August. The whole time the stock was basically sub 30 on the RSI. So that's why, again, you can't just look at one indicator. But technically, it's been climbing. It had a nice bounce off the mid-Bollinger Band. It's sitting here at 50. It recently hit, now I got to bring this back up. This week it hit about 53.73, which of course was well above the top Bollinger Band. We had a big rejection, but technically we're up here for the week. And we're probably, again, going to slowly keep climbing. And also on the weekly time frame, you can see, look at that 50-day moving average, 58.45. And if we trend upward here, up, look at that, 58.70, right? Maybe a couple of days after, 58.40. But we also have earnings right there. So in my opinion, that's why I'm saying it may slowly run up, retest that 50-day moving average, you know, get some momentum going into earnings. And then if it's kind of another trash quarter, you may see the big rejection. And we come back down into the 40s and potentially 30s. But pivot points real quick. And on the weekly, we can see next pivot point at 57.5 even, about 1 point away from that moving average. So this is why right now it does seem like we do have this upward momentum. However, we are kind of running into that top line resistance level. So that's why 58 and change, it looks like, may be where it tops out, which technically is about a 15% move from the current level. So if you're telling me, you know, this was an overreaction and you're expecting like a rebound most of the way back up here to like 60, then I can kind of understand what you're talking about in the technicals. But in the fundamentals, in my eyes, it does not look attractive. And the MACD crossed to the upside there at the beginning of August. And you can see we have been on the up and up for 5, 6, 7, 8 green, black, white candles, however you have it, right? 8 over the last 9 weeks have been up. So we are seeing a healthy bounce here, but again, remember, it's probably going to top out on the RSI soon. And it may run up here, maybe to 55 before you have the retest down to about 52, right? And then it could run up to 58. It could run up to, yeah, like 58, 59 going into earnings. And then we may potentially reject. Or we're going to break right through it, right? Just like I said, or we're going to break right through it. So only time will tell, but as of right now, in my opinion, it doesn't look that attractive, and I would look for other opportunities. But that's just me, and whether you agree or disagree, that's fine. Let us know down in the comments section below why you own the stock, why you don't like the stock, if you think it'll be worth $150 in 3 years, if you think it'll be worth $10 in 3 years. Let us know down below, but that's pretty much it. I'll end it there. Once again, Stocks by the Numbers, I want to thank you for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually pretty quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are rocky, they're volatile, they are very uncertain. So I want to wish all of you success. I hope everyone makes a couple of dollars. Thank you for your time. Have a good day.